For rentals, timing is everything. You don't get to deduct lost rent just because the unit is empty, but you can often deduct real expenses during vacancy if the property is truly held out for rent. On the EA exam, they love the difference between unoccupied and not yet in service. Your job is to identify the moment the property becomes ready and available for rent. Here's the available for rent standard. If the unit is ready to rent and you're making a real effort to rent it, like advertising, showing it, accepting applications, then expenses can be deductible even with no tenant yet. That includes things like interest, taxes, insurance, utilities, and depreciation. The key word is available, not occupied. Now the twist: idle property. If the rental was already placed in service in a prior period, you generally keep deducting expenses even while it's temporarily unrentable, like during repairs, after a tenant moves out, or after vandalism. It's still a rental activity. It's just idle. Exam tip: idle property is about a pause after service, not before service. Placed in service is the line in the sand. The IRS phrase is ready and available for rent. If you're fixing the place up before it ever becomes a rental, those costs generally aren't current deductions. They get capitalized into basis. Once it's placed in service, ongoing operating expenses are deductible, and depreciation can begin. This is a favorite EA exam trap. Think of it like this: repairs before placed in service usually become part of what you paid to get the property rent ready, so they increase basis. Repairs after placed in service are usually Schedule E expenses. Same type of repair, totally different tax result, just because of timing. If a fact pattern gives you dates, purchase date, repair date, first advertising date, use them. Once depreciation starts, you need the right life and the right basis. Residential rental buildings use 27.5 years. Non-residential real property is 39 years. Think offices, retail, medical buildings. And land is never depreciated, so you must allocate purchase price between land and building. On exam questions, if they hand you land and building values, they're begging you to exclude land. One more basis rule that shows up constantly: converting a personal home to a rental. Your depreciable basis for the building is the lesser of the home's adjusted basis or its fair market value at conversion. Then remove land either way. So if the home dropped in value, depreciation is limited. If it went up, you're still stuck with adjusted basis. That lesser of rule is pure exam gold. Darius owns half of a residential rental house, and his cousin Elena owns the other half. The house is rented all year. Last year, Darius paid $968 out of pocket to repair a broken water pipe. How should Darius treat that expense on his tax return? Consider whether he deducts the full amount, only his share, and which schedule it belongs on. Think about it. The correct answer is that Darius deducts $484 on Schedule E, his 50% share. Co-owners generally deduct expenses based on ownership percentage. If he paid more than his share, the extra isn't his rental expense. It's really an amount he's entitled to be reimbursed for by the co-owner. The tempting wrong choice is deducting the full $968, but that overstates his share. Ethan bought a home for $250,000, $50,000 land, and $200,000 house. He later added a bathroom for $18,000. He moved out and converted it to a rental, with a tenant moving in October 1st, 2023. On that date, FMV was $310,000, $65,000 land, and $245,000 house. He also paid $2,400 for plumbing repairs in November after the tenant moved in. What basis is used to compute depreciation during the rental period? Think about it. The correct answer is $218,000. For a personal to rental conversion, depreciable basis for the building is the lesser of adjusted basis, or FMV at conversion, and land is excluded. Adjusted basis of the house is $200,000 plus the $18,000 improvement, or $218,000. FMV of the house at conversion is $245,000, so you use the lesser amount. $218,000. The tempting trap is using FMV, but the rule is lesser of.